All right, this is Andrew Stotz of the Valuation Master Class of Stotz Investment Research. This is case study, and the company is Tesla. And my question is, would you buy Tesla on 19 times 2025 earnings? That's my question for you. So let's look at that in a little bit more detail. Now, I know that a lot of people have questions about and challenges about Tesla. So I want you to have any questions. If you have any questions, make sure you post them. I'd be happy to discuss about it. One of the things about a company like Tesla or any type of startup is that, you know, ultimately entrepreneurs are making bets on what the future holds. And so that's what we're going to be doing here. So let's get into it. This is Andrew Stotz of Stotz Investment Research, and welcome to the Valuation Masterclass case study. And this is where we dig into interesting stocks and their valuations. So today's company is Tesla Inc. What a beautiful looking car that is. Remember, this video is for learning purposes only. It's not an investment advice or a recommendation. This is really me teaching. So let's look at Tesla. The title I have here is Defining a New Era for the Global Car Industry. What are 3 things you need to know about this company? Near-term strength, but market dominance declines. The EV competition is massive. Many American companies fail in China, but not Tesla so far. And rapid production ramp up to ride the EV wave, electric vehicle wave. Now, right now, there's 41 analysts covering the company, and the target price is 911. It's a downside and a sell, a 14% downside and a sell rating. The price to book value, oh my God, the average price to book value in the US right now is probably about 4.5 times, and here it is at 41 times. Now, again, you have to be careful when a company is started. They have a lot of losses going in, so they have retained losses. Their equity is tiny. So price to book is a very misleading ratio. Dividend yield, of course, 0. It's not paying any dividend. Now, here's my estimate. 1,142 is the value of this company. And I'm going to show you how I get there, but also I'm going to show you why you could be buying it on 19 times PE. So first, let's look at the share price. This technical signals are showing, it's in a pretty good rally. And the 50-day moving average is well above the 200-day moving average. It's suggesting that it continues to be a bullish sign. Now, it may start to peak at some point, but right now, from a short-term technical, it's bullish. And the relative strength also indicates a bullish signal, as it's recently stayed well above the 50%. Now, it has stayed above that 50% for a considerable amount of time in the past. Maybe it can in the future. Considering both volume and price, Tesla's share price could ride the momentum further. Let's talk about the revenues of the company. First of all, automotive sales and leasing accounts for 78%. Here you can see their car. The commercial vehicles are still under development. Vehicles, services, and merchandise account for about 16%, and energy generation and storage about 6%. The regional breakdown, well, about half of their volume, half of their revenue is happening in the US, but 21% in China. That's pretty amazing for a startup. And finally, the one in the upper left-hand corner is Model 3, and that is the best seller. Remember, if you have any questions, put them in the chat. And there's Hillary. Good to see you, by the way. Make sure you ask any questions as I go through. Let's talk about the story behind this company. First, near-term strength, but market dominance declines. Here you can see the amount of car units produced, and that amount is the red line, or the red bar, and it shows it in 2021 they got to about almost 1 million, and then they've got a lot of superchargers. So in 2021, Tesla's car production beat analyst consensus forecast by about 7.5%. Pretty darn good. It's been one of the few car makers that has successfully mitigated the chip shortage. And the company has rewritten its software to support alternative chips. That's an advantage that Tesla has that many of the other car companies don't have. Now, Tesla's competitive advantage also lies in the dedicated charging network that currently covers more than about 3,000 locations in the US and around the world as it grows. But competitors are scaling up fast as well. Here we can see the first mover advantage of Tesla is increasingly diminishing as competitors invest aggressively. Volkswagen is allocating, and Volkswagen, you can see, is catching up to them. They're allocating $100 billion in CapEx to push forward electrification, in the next 5 years, equaling 50% of its total budget. As a comparison, Tesla aims to spend about $50 billion over that same time horizon. General Motors and Stellantis follow with a $35 billion allocation each. Now, it's important to talk about Volkswagen in particular and BMW, because right now, what we can see is there's a lot of struggle with energy prices in Europe, and particularly in Germany. We've got natural gas prices that have risen massively. And remember that also hydrogen is an output of natural gas. So if you're a hydrogen company that's focusing on hydrogen cars, like we looked at Hyundai and Toyota, that can be quite expensive right now in Europe. So I think that Volkswagen is definitely under a lot of pressure to continue to expand. Now, many American companies fail in China, but not Tesla, at least not yet. China is the dominant market for EV and battery development. And in fact, just to share a little story, I was studying my PhD in China at the University of Science and Technology in Hefei in Anhui province. And I remember one night I was leaving the university and I was walking out to get some food. And I was walking along a pretty busy road, but it was pretty empty. And as I stepped out in the road, I was almost hit by a motorcycle. How is it that I didn't see this motorcycle? It was because it was an electric motorcycle and they're all over. I couldn't hear the motorcycle because the electric engine was so soft. So the point is, China is definitely moving to electric very aggressively, and they've been there. That was 5 years ago when that happened to me. So that's why I say that China is the dominant market for EV and battery development. In 2021, the Chinese EV sales was 3.3 million vehicles, which is 8 times the volume in the US. Tesla's recognized early that the potential and expanded its Chinese factory to an annual production volume of about 600,000. I think the factory is just is in Shanghai. China already makes up about 29% of Tesla's sales in 2021, and that contribution could go up much further. Now, of course, it could be that we have a conflict between China and America, and that could be a really, really tough situation. But as of right now, that's not happening. So why do most big companies fail in China? Well, having done my PhD there and spent a lot of time talking to my Chinese friends and looking at many case studies, we can look at Home Depot, Uber, eBay, Nike, and Walmart. I remember going into Walmart and seeing it just wasn't being that successful. Even Google, of course, Google exited a long time ago. So here are some reasons why they failed: lack of localization strategy, government and regulatory hurdles, underestimating domestic competitors, rapidly changing market, and lack of understanding of the cultural sensitivities and just cultural in general. So now let's look at the fact that Tesla needs China and China needs Tesla. Despite the US-China trade war, China has supported Tesla in building its Giga factory. It granted Tesla cheap access to land, tax incentive, and low interest rate loans, just like states in America, like Alabama, North Carolina, and many other states. Kentucky did it with Toyota. They offer a lot of incentives to get the global companies to come. In return, Tesla is supposed to advance the Chinese EV industry and stimulate competition for technological progress. This is also called the catfish effect. In fact, you can look it up on Wikipedia, which I did here. And the catfish effect is the effect that a strong competitor has on causing the weak competitors to better themselves. It's actually a fun story about fishing in Norway and sardines. Actually, it's quite interesting. So this interdependency allows Tesla to succeed in China while other US companies fail. By the way, nice to see you all here. I'm going through the valuation of Tesla. I see Hillary, I see Lee, and I see Kazar. Welcome to all of you and all the others who are watching. Let's continue on. This is the third story that's interesting: the rapid production ramp up to ride the EV wave. Tesla builds its factories at an enormous speed through ready-made construction elements. Chinese factory took about 168 days to build. That's incredible. Most companies can never, ever do that. Now, 2 factories in Berlin and Austin, Texas are on the edge of opening, adding more than 1 million cars additional capacity in 2022. We expect the company to reach an annual production of about 2 million cars by 2023. So if you want to upload the slides, if you want to get the slides that I'm going through right now, just scan this barcode or go to the Valuation Master Class blog and you can get access to it so you can go through it in your own time. Now, let's look at the FVMR scorecard when it relates to Tesla. We measure a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And the scale is from 1, which is best, to 10, which is worse. And just to say hi, Chen Yang, welcoming you from Singapore. Great to see you. And I know Hillary's in Nigeria. And Hillary, you're exactly right. That's like overnight. Could that happen in Nigeria? Could that happen in Thailand? Could that happen in the US? Unlikely. It's pretty impressive. So here we have the scorecard that I use to measure the performance of a company relative to global peers. Here, I'm comparing it against 2,170 non-financial companies in the US. And I want to look at momentum, because if you look at this, I'm just going to grab my pen here. As a teacher, I got to point something out. Hold on. Basically, what you can see is if it says B, it means it's ranked number 1. If it says W, it ranks badly. That's worse. Here we can see the valuation is really bad compared to 1,170 non-financial companies. But man, that momentum is amazing. So let's look at the momentum in more detail. Here you can see in the past 12 months that revenue growth was 66%, 719% for recurring EPS growth, and operating profit margin is improving. This is what happens when a startup company starts to really, really get the momentum. And that's where I think the potential is. It's not easy to buy this company right now because it is quite expensive, but the momentum could drive it. In fact, in just a moment, I'm going to show you how to think about that momentum. Now, recently, I created a short online course explaining my FVMR approach to investing. It's a $97 course, but I'm offering it for free right now. You can scan that barcode and go take the course. All right, let's talk about the forecast. There's 41 analysts covering the companies, and consensus remains optimistic regarding a profitability turnaround. But analyst consensus are forecasting a downside right now. And here, I just want to highlight that when we look at the recommendations of stocks here, from strong buy to strong sell, what you find is that analysts almost never have sells or strong sells because they don't want to insult the company and blah, blah, blah. There's a lot of career pressures why we don't see it. But here we see with Tesla, they're not afraid to say it's a sell right now. And that's part of the reason why we're seeing this downside. It's an expensive stock for sure. Analysts are mixed. There's a high dispersion among analysts, and that's usually rare. There's 10 sell or strong sell recommendations. Consensus expects revenue to continue growing at a very fast pace. And let's look at the P&L for a moment. Here's some expectations that we've pulled together for revenue. $51 billion in revenue in 2021. It's almost closed the year, and it's almost there. And we expect that that's going to increase to about 72 or 73 billion in 2022. Tesla started to get black ink now, going from negative to positive. And that turnaround for any startup company is always powerful, right? Always powerful. And I see 2 there. Thank you for that. Great presentation. Yep. With the production ramp up, it generates growing profits. You start to get economies of scale, and you start to get operating leverage effect. So let's look at the balance sheet. The company has a massive cash position now. It's holding around 37% of its assets in cash as of 2020. And one of the things that I think is worth talking about just briefly is that when a company like this startup Tesla, now it's no longer such a new company, but when the market capitalization goes up so high, it's usually the case that the company can issue and will issue shares to raise capital. And when they issue those shares, they do it at a very high price, and therefore they don't dilute the existing shareholders nearly as much. And then they can use those shares to pay off debt and all that. So Tesla really did hit the mark on that. And so they have a lot of cash. So, and there's a heavy fixed asset investment. We can see about 20 billion in 2019, 23 billion in 2020, 30 billion in 2021. And then we're expecting about 32, 33 in 2022. Now, here's where you can see that capital raising that I was just talking to you about. It can be seen right here in the financials. Here it is. The common shares went from 12 to 27. That shows a capital increase. They raised capital in 2021, and it was a great time to do it. They could do it without a lot of dilution. Tesla has a moderately low level of leverage, and liabilities to asset ratio stood at about 56% in 2020. And we can see that retained earnings is starting to turn positive as the company's making serious profit. And there's Tibohu. That's great to see you. It's been a while since we've seen each other. Tibohu was in the Valuation Master Class Boot Camp, and we do valuations like this in there. So cash flow statement, let's look at some things. Operating cash flow could turn massively positive in 2022 and heavy CapEx in 2021 due to the development of 2 further giga factories that they're working on. And let's now look at growth and see. Here's some of the revenue growth that we've seen, 14.5, 28.3. If Tesla can continue to ramp up production, it can continue to sell at a fast pace. And as Tesla moves closer to full capacity of its existing plants, we expect a higher efficiency ratio. I want to focus on this particular ratio, revenue per 100 in assets. We can see it went from about 77, and we expect it to go to about 108. I would like to talk to you just briefly about this particular ratio. I think it's such a fascinating ratio, and it's one that people don't watch all the time. We look at ROE and many other things, but this is a component of ROE. And what you can see about this ratio that's interesting is imagine that you have 2 factories right next to each other doing the same thing. One factory costs $100 million to build, and the other factory costs the same, $100 million to build. One factory, the first factory, generates $100 million in revenue. That's a 1-to-1 relationship. We can also multiply that 1 times 100, and then we can say for every 100 in assets, they're generating 100 in revenue. And that's the ratio I was just showing you. But imagine the other company. They could generate 200 million in revenue. So for every 100 in assets, they generate 200 million in revenue. It doesn't mean that they make more profit, but it means that they're getting more out of their facility. And when this ratio starts to rise, what I've seen from an investment perspective is it can be very indicative of a rising amount of equity, return on equity, and a share price rise. And we can see what's happening here. If I just look at the ROE's gone from negative to 5 to 19 to 25. That's a massive increase. And it's being caused by both net profit margin and this level of asset turnover. You can see the assets to equity has actually gone down from 5.5 to 3 to 2. This is very high quality ROE production. So very impressive there. If we look at EBIT margin right now, we can see that EBIT margin has been rising substantially. And Tesla has also become a net cash company, no longer having a lot of debt. They have more cash than they have debt. So they're not leveraged. They're not at risk there. Let's talk about valuation. It gets a little bit crazy here when we look at the valuation. Right now, the PE ratio of Tesla is 158. It trades on a massive multiple. And so we want to also take into consideration its growth potential. So the best way that we know how to do that is to look at a PEG ratio, PE to growth. And it trades slightly above the average for the US, slightly below. Of course, we want a lower one if we can get it. Lower would be cheaper. So if we look at it at a PE to growth, it doesn't look like it's as expensive as if we just look at PE. But we have to accept 158 times PE is damn expensive. So I want to go through a thought experiment. But before we do that, in this valuation, let's say that Tesla re-rates to the industry average. And if that's the case, that's how we come up with our valuation in this case. But I want to go through an exercise and go back to the title of this presentation. Would you buy Tesla on a 19 times PE of 2025? Here's how I get to that. First, if the volume of Tesla cars sold goes from 1 million units in 2021 to 6 million in 2025, things go well, and they're able to pull that off. And the price of the car rises by, let's say, about 10% per year. This would mean revenue grows from about 51 billion in 2021 to about 446 billion by 2025. That's a 10 times increase in revenue, almost massive. Now, let's assume that net profit margin rises from the current 9% to 12%. Come on. Could they get more than 12%? I think it's very difficult in a highly competitive market, but they are differentiated. Then Tesla would produce profit in 2025 of 54 billion US dollars. The company currently trades at a 213 times 2021 PE because remember, they don't have a lot of profit right now. But that would fall to 90 times in 2022 using the assumptions I've just gone through, 37 times 2023, 25 times 2024. And if they could produce a profit of 54 billion by 2025, you'd be buying it on 19 times 2025 earnings. Now, of course, we're looking far out in the future. There's a lot of questions and risks. So you're not necessarily going to just think about that 19 times, but that's one way to think about it. Now, what's my value estimate right now for Tesla? 1,142. That's about 11% upside. In a bull case, I could get it up to about 24. And in a bear case, I can say this share price is not moving. Let's look at the world-class benchmarking scorecard. And this is where I think it gets interesting. We identify a company's competitive position relative to global peers. Combined, we look at this combined composite rank of profitability and growth, which we call profitable growth. And the scale is from 1, which is best, to 10, which is worst. So let's look at Tesla. Tesla was originally ranked one of the worst in the world at a 10. And this is compared against 1,040 large consumer discretionary companies. But this is pretty damn impressive because now Tesla is at a 3 for the past 12 months. That's very impressive. So they are improving their profitable growth score relative to peers. That's happening both in profitability, where we're seeing the net margin rise, but it's also happening in growth, where they're able to deliver the cars and sell them. So these guys are doing pretty damn good. So there's room for improvement in profitability, but you can say that growth is exceptional. So really, it's about continuing to hit their growth targets and improving profits a bit. What are the risks? Well, the key risk is a diminishing competitive advantage. Competitors could close the tech gap faster than expected as they invest heavily. Also, adverse regulatory changes in China could hamper the business, and sentiment could lead to volatile stock price movement. And finally, I would say if there's a trade war that gets even more serious between China and the US, then that's going to be a problem. So let's wrap it up. Defining a new era for the global car industry, Tesla. My estimate is about 11% upside, and you can see the key stories here. So the conclusions. Tesla's success lies in the EV dominant country, China. Delivering high profitability could convince skeptics, and Tesla's high PE sounds more reasonable when relating it to the massive growth prospects that it's having. So would you buy Tesla today on 19 times 2025 earnings? That is my question for you. And that is the key question that we all face now as we look at Tesla. My name is Andrew Stotz of A Stotz Investment Research, and this has been a Valuation Masterclass case study. It's great to see you here. Feel free to leave any questions in the chat.